Good afternoon. I'm Chris Swift, and on behalf of my partner Chris Wimard and Sean Ganlon, welcome to this edition of Shooting the Bull. Last time we discussed, we talked about the cattle cycle nearing an end. Well, I think it's found that end. So today we're going to talk about being at the end of a cattle cycle, what that means, and what we might be able to do about it. So today we're going to talk about money, interest rates, and the cattle cycle. Money clearly is what it takes to be able to buy them. The interest rate, because we have to borrow that money, and all that does have some impact to the cattle cycle. So let's look at money first. And I drew out a couple of time frames here, 13 through 16, because that's when we see that the number of cattle fell the most. And we had just gotten through with a major drought in 2012. So the 13-16 time frame was a large increase in price for the feeder cattle, fat cattle market. And we see that the dollar at that time went up immensely. But after that, we had a small move down in the dollar around 2016. From 16 to 17, it rose and it got just a little bit higher than what it did in 15, but then once again collapsed and pretty much stayed sideways from that point forward. If we look over to the right, we've had another large injection of money. The $3.5 trillion that the federal government spent on the economy, that's what that big rise is. Now, all that money is trying to be sucked back out of the system, either through higher interest rates or right now, the higher inflationary prices of all the things that we survive on. We can see that we continue to poke below that trend line that we've got drawn right here. And if we ever close a weekly below this low right here, I think we could probably move back down here into this wave four low around $90. Now, that would be great for our export markets if beef exports really contended a lot on the dollar valuation. It doesn't. It primarily hinges off the price of beef. However, we do know that we are in an inflationary aspect and probably going to continue in one, so that should decrease the value of our dollar. If our next administration is similar to this one, we can probably expect greater printings of money and have that dollar devalued even greater. In the bond market, we see the 13 through 16 time frame where we saw a little bit higher interest rates as we went to 13, 14, but then from 14 all the way up until 16, we saw lower rates. We got the economy a little bit running hot, and so we raised rates, and we see the price of bonds went down in the 16 through 18, 19 time frame, and then back up again. And as we needed to pump more money out into the system, that drove the price of money literally down to zero, if not negative in some cases. And that's the big spike that we see up here. Now, if we look at the levels, we are trading interest rates higher than we have since 2012. And even in the low part of the 2013, when we began expansion in earnest, we still had lower interest rates at that point than what we do right now. Not to say rates will go higher or lower, but more than likely they'll stagnate. And they could trade in a range between 135 and the 110 where they were just a couple of months ago. They could trade in that range for a long time as we continue to do a couple of things with our economy. Try to tame inflation, get some of those prices down. And the only way that we know to be able to do that is to continue to pull more money out of the system. The more money we pull out of the system, the less likely it is certain people have the ability to continue to purchase at this particular level. So we go to the 13-16 time frame, and that's where everybody's excited for the big rally. We've already seen the same thing happen now in the 20 through 24 time frame. But then right after that, it was a massive collapse, and the 16 through 21 time frame produced enormous losses for most cattlemen. Very low cattle prices in comparison to what we have to remember that, yes, a lot of those cattle were traded within a year's time and didn't appreciate that. But everyone in the cow-calf sector, those cows just kept having calves. And if you paid anywhere within the top $200 for those replacements in there, for the next 5 years, you sold them all at a cheaper price. So the price of the 2013 through 16 time frame, we can now go back and flip and see that in each one of the dollar values and the bond market. And we can see that we're a little bit different today than what we were back then. So now let's try to figure out how we got to where we are and how we're going to get out of it. And right now we see the bottom of this market right in here through the green part was a little bit of the COVID in the red. The economy halts and the government prints money. That's what we see in the red. If we took that red out and we took that bottom portion of that trading out from about 130 down to 115, we can see that we are pretty stable in both prices, production, and everything until we get right at the end of 21. And that's when the bulk of the money that the government printed started flowing into the economy and it poured in. And the aspect of it is that people that had never been able to afford certain things could. And that created the inflation. Now we've risen the price of beef, we've risen the price of gasoline, we've risen the price of most every aspect of our life that we have up to very high levels, with beef included. So what do industries do when we see this great big move in price? They want to capture some of it. So we looked at an idea and we started seeing a couple of things taking place. We saw more beef being imported. We saw fewer slaughter cattle during the week, allowing them to grow bigger. So we increased the number of the amount of poundage that we had per cow, and then we continue to increase and discover more of how efficient the dairy beef cross is. That brought us to the high of 23. And the recognition of that agenda, which had at that time almost equal total beef production from the previous year, spooked everybody, and the market collapsed. Profits dried up at the top end of it, and everybody saw that the industry as a whole was working very diligently to try to get as much beef in the U.S. here to satisfy our consumer without raising the price so high that it actually killed the demand. So then we rallied, and this is the last rally that we've got so far. This is what I consider to be the fifth wave rally. Cattlemen are still bullish. Cattlemen are going to have to conduct business in the cattle business regardless of what the price is if they're going to remain in the cattle business. So you will always naturally have some ebbs and flows in the market. And I believe that what we're seeing right now is that there's just fewer cattlemen out there making money, and the losses are building, and just the sheer amount of capital that it takes to own these is starting to put a few people out of business, or at least keeping them from expanding. So there we have the rationing again. The higher price is beginning to ration the number of participants that can participate in this market. So then we're setting up for what's going to happen next after this cycle. So we're at the point right now where we're just coming off, the cattlemen are still bullish, but fewer of them. Profits are drying up, and now we're starting to see declines in the market. I think it is nothing more than further recognition of the agenda, because here we sit at 1.3% differential in meat, total red meat production year over year. Expectation was to be as much as 12 to 13% decline because of the number of cattle that we had lost, or thought we might pull out from expansion, which didn't happen. We just kept pushing more cattle into the slaughter mix, and clearly the amount of money that was available out there is what kept pushing more cattle into the market instead of holding them back for breeding. We're going to talk about that breeding here in just a second, but expansion. So we see that what we think right now is the further recognition of it, and we're starting to see a price decline. That price decline, in my opinion, is not over with yet, and may eventually take us down to the previous lows that we saw back in December of 23. You get that low in there, and it starts to even look kind of like a head and shoulders now. But it may not be over with yet, because expansion will then start to take place somewhere around the spring of next year. We have lower hay prices, we have better pasture conditions, and we have cow-calf operators that seemingly are flush with money, because at least for the last 4 years, they've sold cattle consecutively higher, except for maybe 1 or 2 months out of that 4-year period. So we believe that the cattle industry, as far as production goes, should be relatively flush with capital, making expansion even easier. Well, now I can hold back that heifer. I can go out and buy some new heifers, but something that I think that might cause that next leg down after we continue to conduct business under a more normal thing, I keep looking at the percent of cow slaughter down dramatically, and dairy cow slaughter down even more. This is my opinion, has nothing to do with fact whatsoever, and I cannot prove it, nor probably can anybody else. And it may be laughed at, but what I'm thinking is that although I understand that cow numbers are down because we have sold a lot of them, we have really wanted that lean meat for our trimmings, but I think it's possible that some of the dairy loss that we're seeing in slaughter is holding that cow back. And if you recall, back in the 13-14 time frame, there were numerous cow-calf producers that looked at Bessie and said, if she could produce one more cow, if she died during childbirth, we'll still net $500. The cow was worth $300 going to as a boner or a cutter. Now it drops a calf. The calf was worth 800. The cow dies. They still got a $500 profit. They made $200 more than what they would have had they just taken the cow to the market. So I think something similar in the dairy industry. They pulled very hard on the dairy breeding cattle to produce this beef. Well, we started to see some lower milk production out there, and I am hearing rumors of it's going to contract even further going forward because some of these cows have been diverted into beef production. How all that works just yet, I'm not quite sure, but I have to believe that in less than 6 to 12 months, we may look back at this time frame and go, the whole time we were worried about not having any cattle, the dairy beef industry was in the background, just creating a very efficient way to produce beef. So that's what I think may end up happening. And all that would come about. If we think about it, we go into expansion sometime in 25 and prices go back up again because we hold them back. And now we look at 26 coming and we think, well, guys, if we don't look out, we're going to have a calf crop in 26. And by 27, that calf crop will be ready to be entered into either the beef market or being fed out to be in it, all at the same time that the agenda has created more and more beef through multiple different aspects of imports, the growing of what we have domestically more, keeping the high price to the consumer is quelling the demand. We've already seen an enormous shift from cuts to the grind. So it's going to be very difficult to get that consumer back to grilling out steaks again like what they were during the 2024 timeframe, again, because money is drying up. So let's take another look. What we think here going down towards the 27 timeframe, what may create the bigger of the moves down is the agenda plus expansion equals more beef and more cattle. I base a lot of this off of my Elliot wave liking. I very much believe in this. I think it holds great aspects to psychological movement of human beings. And if we kind of convert that from what we have seen in the cattle market to the cash market, which is the feeder cattle index, that is void of any kind of futures trading, any kind of hedge fund, commodity fund, algorithmic trading program. It has none of that. It's whatever that cattleman walks into the sale barn and decides that he himself wants to pay based upon any information and all the information that he has on hand. So what I believe is the cattle cycle from 2020, where we went down immensely in numbers and very, very low demand and very low packing capacity. We created a huge demand for beef by pumping money into it, and we started a 5-wave cycle that is believed to have ended in July of this year. So let's take a look further and let's see what the market looks like. So we have our 5-wave count up to the wave 1 that we see in June of 22. Then we come back and we trade almost a full 6 months sideways and then back up again for wave 3, back down to 4 and up to 5. I may be off by 1 or 2 wave counts. I could be off completely, and we're fixing to soar another 5-wave move up and make $300 for feeder cattle. It is always possible, but it is very improbable due to the money aspect. You got to have money to do that. That means that fat cattle would have to be $200 plus, and the consumer willing to pay $24 a pound for steak, maybe even as much as $10 a pound for hamburger meat. That's what those prices would consider if we thought that we were going to go back up. But because we believe we have completed a cycle in here, we have to believe that the next most probable move is an ABC to the downside. That being to the right-hand side here, where we see the markets trade A, B, and C. And to get us a little bit, so intermediate, each 5-wave count makes up one of a greater degree. So I took that down to the lesser degree on the daily chart. Starting with the major wave 4, I can count 5 waves up with each one of those counts having a 5-wave count in them. But the most important aspect is now, what do we do? Next most probable move is an ABC to the downside. And we believe that that A wave is going to equal the major wave 4 low around 214, 215. So this is just the start of it right here. From the top, we come down and we can already count out 5 waves. We believe that we'll trade a little bit lower in index and maybe even down to this low right here. And then we'll have a correction. And that correction could trade anywhere between where we stop at all the way probably up to around 254 to 256 if it really gets cranking hard. So that would be our correction. And that timeline may be from right about now going into the end of September, maybe the 1st of October. Again, elections are going to be coming up at that point in time. And regardless of the administration, we still have factors from the COVID that we're dealing with, primarily pulling money from the system, not feeding it back in again. So as we look at this last chart right here, we go back and we look at the major wave count, 1, 2, 3, 4, 5. We should then expect a bear market ABC correction. And that's what I think we've got here. I think if we look at the weekly chart, we can see our 5 wave count up, the major count in green. And then this is what we should expect. We should accept an ABC to the downside. The rally was 4 years and 2 months. So I just counted 2 years out. And that's why we get the August of 28 of 26 in there as where we possibly might see the low. And if we think about it, we go into expansion in 25. We produce a calf crop through 25 and 26. That calf crop's going to be ready for marketing into the beef market in 27. In less than 3 years, so 2.5 years, I think we could be down to the 180, 170 range for feeder cattle. And I'm not real sure where the fats are, but the reason I chose the feeder cattle market is because we have the cash market of the index. And it is so prominent with all of the cattle that are traded within the United States within a certain weight class. We've got them all here. And again, it is void of any kind of influence from what we can see in outside market factors. Those would then have to impact the human individually, and then that human be impacted when he went in to make his bid offer sale. So this is what we're looking at. I think we got a long way down to go, and we might have one more opportunity here to be able to get back up to a level that says, okay, well, we missed the top, but here's our second opportunity to do something. Let's make sure that we're doing something out there. We have all agreed here in the office that we're not going to get too bullish at the top, but we're not going to be too bearish at the bottom. Right now, we're trading at $10 to $11 positive basis, suggesting the index will have to drop another $10, $11, $12, $13 just to reach where the futures are right now. So if that materializes, then that's what we're after right now. We want that convergence of basis to take place. If it does, we think that we could either see futures higher, cash lower, they meet in the middle, and we have some kind of formation rally back up. That's a wave 2, a wave B correction, and then we start back down again. Now, if we go back one slide here, and I'm going to take just a second, we're going to go back one slide. We're going to look at this again, and we're going to say when the market goes down ABC, here is the 25 through 26 time frame. That's when we actually may get a rally of some significance here, not this A wave that we're in right now, but the time frame somewhere around the end of 25 all the way through a large portion of 26. So we hold more heifers back. We see what the cow kill is then. And if we have not really done anything more than just keep beef production status quo, I think we could see a little rally in the market and come back up. That would be the time to prepare for what may be coming next. And that would be something similar to what we saw in 14 and 15, where in 2014, it was recognized that the market was going to have more beef. When we got to the end of 14, we said, but the beef isn't here yet. And the market rallied in 2015, but it never reached the top again, because by the time it got through rallying, the cattle were done and the beef really was going to be there. I think the same thing here. We're just now recognizing that the market coming down and the aspect of a 3-wave move back up through expansion should give us a pretty good time frame to be able to work through our production, see how we're going to manage our next procurement and marketing of cattle. And maybe you'll be able to use this chart pattern right here as a way to help you to be able to say, well, I don't really need to be buying anything right now. I may need to be selling quite a bit more. And if we reach some of those levels towards the A wave around 215, 216, then we might have an opportunity. So keep this all in mind. I know that this is tough times. These are very volatile markets. We try to help you to mitigate some of that risk. You can't ignore it. You can't get rid of it whatsoever, but you can mitigate it. And that's what we're here to help you to do. So anytime you need something, feel free to give us a ring. Call myself, call Chris Wimmer, call Sean Gammon. We'll be able to help you any way that we can. And opening up an account is probably always the hardest thing. Nobody likes to talk about it because it's time consuming and it's a little much of a commitment. Once you get that account open, you're pretty much committed. You need to start doing something. So let us help you take a little bit of that fear out. We're not bad people. We try to do really good, and we want to help you to be able to make as much money as you possibly can, or even better, save you some opportunities here that we kind of see forthcoming. So if you need us, feel free to call us. Again, on behalf of Chris Wimmer and our sales assistant, Sean Gammon, thank you, and I hope you have a great rest of your afternoon.